Good afternoon and welcome to the EVANS Group PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Peter Hadsley-Chapman, Chairman.
Thank you, Paul, and good afternoon, ladies and gentlemen. And thank you so much for taking the time, and I have to say, this rather sad time, to hear our presentation following the interim results that we announced to the market yesterday. I'm pleased to say we have our full executive team present in the form of myself, Chairman, Matthew Coulson, who is our Chief Executive, Luke Shaw, who just very recently, on the 1st of July, joined us as our new CFO, and we have Chandra, who is at his home actually at the moment in Malaysia, who is in charge in Asia of our running our Indonesian operations. So we plan to take you through the presentation, which we hope will try to restrict to about 30 minutes. We'll keep the whole presentation to roughly an hour, which will give best part of, we hope, 30 minutes for any questions, which we'd be delighted for you to ask. Without further ado, I'll kick off. I might just, you see that emblem in the top right of that picture of our plantation. Strangely enough, we're not absolutely sure of the founding date of MP Evans because all the records were destroyed in the Blitz in the war. But nonetheless, we know it was in the early 1870s, and we've chosen to commemorate that time over the course of the next 12 months in various ways, which are still to be sort of fleshed out. Next slide, please. That is the agenda, which you can happily cast an eye over, but we will move straight to the next slide, which is who we are. Many of you are familiar with who we are, but a number of you perhaps are not. And as I just indicated, we're a 150-year-old company. We've always been in the plantations business. We're AIM listed, and in the last number of years, really best part of 20 years, we've increasingly focused on producing sustainable Indonesian palm oil and have expanded very rapidly in that area in that period of some 15 to 17 years. And we now employ more than 10,000 people and are responsible for looking after many more people in terms of their families who we house on our plantations. In terms of what we now have established, it's around 40,000 hectares of our own group-owned plantation areas, and a further 12,500 hectares, which we manage on behalf of our associated scheme smallholders, which are adjacent to our projects and are managed to exactly the same high standards as our own. The two are literally indistinguishable. We've invested over $500 million in expanding our Indonesian business since 2005, when we took the decision to sell the small Malaysian estates which we owned and use the proceeds to expand substantially into Indonesia. The RSPO, by coincidence, was formed around that time, and we have, of course, always operated strictly by their principles and criteria. And Matthew will elaborate more on some of our ESG initiatives and measures later. These are our they're not just empty words. These are our 4 core pillars, if you like, which are all very important to us, and they all link in a sense, one with the other. I just touched on responsibility, which not only concerns the E side, the environmental side, although that is absolutely fundamental, that we don't, for instance, deforest, clearly not, nor burn. We treat the environment very sensitively, but also the social side, in terms of the high quality housing, the new schools that we've built, the employment of teachers, the medical facilities that we have. These in turn all help to attract the best quality managers and staff and encourage them to stay with us. And therefore this leads to an excellent quality of management. And through that excellent management, that helps towards achieving better growth through increasingly sort of better agronomic practices, which help to improve our yields. And our yields are also improved through 2 other sources. One through the very fact that our plantations as an average are still young, and so every year they're getting more mature, and the crops, the levels of production are growing as a result of that greater age. But also we are now very much on the lookout to acquire new areas. So by virtue of inorganic growth, if you like, by buying new areas, we will increase our production. And this in turn feeds through to the final of the 4th of our pillars, which is that of yield. And here we mean dividend yield, returns to shareholders. And we will later show how important this is to us, and of our, I think, rather impressive track record when it comes to dividends. These are just the highlights of our results. I'll just very briefly touch on these. Each one of these points will be elaborated on, but very quickly, our group crop was increased by 4%. It will be explained as to why it wasn't a greater increase than that, as we are growing, but for the first half it was a 4% increase. Because for reasons which will be explained, the amount that we bought in from the independent smallholders was lower. It balanced out and resulted in an almost exact same level of CPO production for the first half, although that is now increasing in the second. The average price for the first half, for reasons which will be explained, was fantastically strong, 43% increase, and pleasingly, back to the sustainability theme, a 74% increase in our sustainability premia. There were increased costs, which Luke will touch on shortly, but nonetheless, there was a 49% increase in our operating profit and a 65% increase in our earnings per share. A 25% increase in the dividend has been decided by the board, namely an increase from 10p per share to 12.5p per share. And we've also, pleasingly, turned around the debt on our balance sheet that we had last year to a net cash surplus. Perhaps I can now hand over to Matthew to talk initially about the palm oil market.
Thank you, Peter. So I think it's important just to set everything in context by looking first of all in a bit more detail at the palm oil market in the first half of 2022. And perhaps it's best first of all to focus on the graph in the bottom half of that slide. And we look back first of all to 2018, 19 and 20 to remind ourselves of where things have been before looking then at the first half of 2022. And we can see by looking back before looking at the first half of 22, it reminds us that actually the first half of this year really has been a remarkably high price environment for palm oil. And the average the average Rotterdam price has been over $1,600 per tonne in the first half of the year, up 45% on last year, which we can already see was a rising and a high price situation in itself. So to be over $1,600 per tonne as an average is really quite remarkable in a historic sense. Now, why is that? Well, we look at the chart again and we can see there was a point in late February and into early March where that chart actually becomes almost vertical. And that really is a reaction, not just in palm oil, but in a number of commodities and certainly in a number of vegetable oils, to what was going on in Ukraine, and with the outbreak of war there, concerns over supply of vegetable oils, concerns over what might be happening with the supply, particularly of sunflower oil, with Ukraine supplying almost half of the world's sunflower oil. And so we saw a very sharp reaction in pricing for palm oil, with Rotterdam prices very nearly reaching $2,000 per tonne. I think the peak was actually $1,990 per tonne. So average Rotterdam prices over $1,600 per tonne, and that meant average mill gate prices for us, so what we actually received for our production in the first half, averaging over $1,000 per tonne, $1,035. Quite remarkable pricing. And as it says there, and as Peter mentioned, 43% up on the same period last year. And again, looking at the chart, you can see that already was in a rising and very high market, even in 2021. So to see another step up of that magnitude in 2022 was quite a remarkable pricing environment. Now, inevitably, in such a high price environment, we saw some changes made by the Indonesian government to the way in which they taxed palm oil and how they approached taxing and providing levies, tariffs for the palm oil market, even to the extent that at the end of April and into some of May, they actually put in place a temporary ban on its export, which came as something of a surprise to market participants, and on the face of it was something that didn't make a whole load of sense in the sense that when you look at Indonesia and the production that comes out of Indonesia, around 60% of world palm oil production comes from Indonesia. Now, Indonesia is also a very big consumer of palm oil, but nothing like to the same extent. It consumes something like 20% of world palm oil. So you can see there's a big imbalance there, and turning off the taps of exporting, even for a short period of time, is going to cause substantial excess stock to arise within the country. And that's exactly what we saw happening. Now, as a result of that, when the ban was lifted towards the end of May, we saw a significant amount of that excess stock coming onto the market, being exported. And inevitably what that meant was there was then a price adjustment, a price reduction, and hence you can see the story of that in the chart. Interestingly, we also found a situation where the Indonesian government put in place an export tariff on top of the export levy and the export duty for a short period of time following the lifting of the ban, which meant that for a short time, the tax situation, combination of the duty, the levy, the tariff, was a substantial tax burden for a short period of time. That has now changed, and we now see that the tax environment is far more benign, and we find ourselves in a situation where mill gate prices are now improving, and we now see mill gate pricing right now back in a $700 to $800 range, which again, we have to remind ourselves of the historic context. You know, it's not the $1,000 we were seeing in the first half, but again, like I say, remind ourselves of the historic context. $700 to $800 a tonne is an extremely healthy mill gate price to be achieving, and one at which we will achieve very decent margins for what we are selling. It's also very important to talk about sustainable palm oil, coming back to what Peter was describing as our first and most important strategic pillar of being a responsible producer. And we believe that when palm oil, when produced sustainably, provides a very high yielding and low cost supply of vegetable oil into what continues to be a growing global market for vegetable oils. All of our areas are run absolutely to sustainability principles, and fundamentally that absolutely means no deforestation and no burning. But it means a lot more than that for the group as well. And we try to illustrate that in some of the pictures on this slide. If you look at the top left-hand picture, you can see one of the group's biogas facilities. When we develop our mills, we develop fully integrated mills wherever we can. That will include developing a biogas facility to turn methane into green electricity, to not only run our own facilities, but also to sell excess power to the local grid. In the bottom left-hand picture, you can see one of our composting facilities, where we take the empty fruit bunches from the mills and turn them into an organic compost to send back out into the fields. And then on the right-hand side, you can see pictures of one of our conservation areas, an example of what biodiversity means and what biodiversity looks like on one of our estates. Peter's mentioned the fact that we're a long-standing member of the RSPO, and all of our mills are either already RSPO certified or will become RSPO certified as we work through the journey of certification after those mills are opened. And again, we go above and beyond, and we work with independent smallholders who supply us with fruit for processing in our mills to help them in their own journey towards RSPO certification. And you can see as the final point on the slide there is a financial consequence of this as well. There is an additional amount of income, an additional amount of sustainability premium that we receive when we sell our output as certified sustainable oil. And that premium continues to increase. So we received $3.3 million in the first half of the year, up from $1.9 million in the first half of last year. And then we also wanted to share just a case study with you, again, thinking about what responsible estate development looks like and what it means for us. You know, we are committed to providing a full range of facilities for our workers and for their families, particularly when we think about some of the more remote estates that we have in the group. And a good example of that is at our estates in East Kalimantan. And in those estates, we've already opened 2 junior schools and 1 senior school for children of our estate workers. And we already have over 600 pupils enrolled in the current academic year in those schools. And it's an ongoing process. There's further expansion taking place in those schools. And we have another school planned to be opened next year as well. And again, you know, I can explain this to you. We can put words on the slide, but hopefully the pictures give a good illustration of what we mean and what those schools are like. So I think at this stage, I'd like to hand over to Chandra to talk us through crop development and milling development on our estates. Chandra, over to you.
Yeah. Thank you, Matthew. I will explain crop development, which is shown in this slide. This slide is made up of bar charts. On the far right is the total crop processed by our mills. And the bar chart shows for the first half of financial year 22, January to June end, and versus the financial year 2021. In 2022, January to June, we processed 705,599 tons, compared to 702,342 tons. It was only a 0.5% increase. Basically, total crop that we processed remained the same for the first half between this year and last year. Total crop process is made up of own crops, scheme smallholder crops and independent crops. This crop that we purchase from outside villages, small companies which don't have mills, we support them. For own crops, we had a 4% increase compared to last year. We processed 430,000 tons compared to 413,000 tons. For scheme smallholder crop, that is schemes, cooperative schemes that are managed by us and of the same standard, we also attained a 4% increase compared to last financial year. For independent crop purchase, we had a significant reduction in the financial year 2022. We only purchased 148,000 tons compared to 168,000 in financial year 2021. The reasons being, when the CPO ban was put in place, prices were not stable, and we did not want to participate in a very speculative market for a month. And another very important reason is we had to manage our storage tank space. We had to harvest our own estate crop as well as scheme smallholder crop. Hence, we needed to keep the space. Nearly all producers in Indonesia suffered a logistic issue where they could not find barges to clear the oil because of the ban. Because of the ban, oil was not exported out. So most of the oil were kept in tanks. So this really caused disparity, caused an issue. So that was the reason why we did not engage in purchasing of independent crop from outside. Hence the reduction. But I assure you that we have gone back. Now that prices are stable, logistics issues have been settled to a certain extent. We are aggressively buying independent crop. So this slide basically tells you that for the first half of the year, there has not been much of a difference between crop production. There's a 4% increase in crop in this financial year. And I can very much assure you that we will attain our budget this year of production because the second half is having a very good run right now. Next, please. The next slide is also on growth and particularly on increasing milling capacity. The bar charts here show you the darker green bar chart show you crop from our own estates. The lighter green bar charts show you crop from our independent smallholder areas. The orange bar charts indicate crop that is purchased from smallholders and small companies around our mills. The linear graph shows our milling capacity. Basically, this graph very clearly shows MP Evans' growth over the last 12 years. We have increased our crop. Our milling capacity in 2010 was only one 40-ton oil mill. In end to 2022, we'll be having our 6th oil mill in operation. CPO production in the first half was 160,800 tons, slightly lower than first half 21, 161,400 tons. As I said earlier, cropping levels are very high now. We are very confident that cropping levels will be very much higher than the last financial year. Production costs, as you know, is lowest when milling our own crop in our own group mills. Production cost of our own crop was $425 per ton. Total production cost in our group mills was $598 per ton. The increase is because when we purchase outside crop and when we buy crop from our scheme, smallholder schemes, we have to pay the market CPO price. This is a really very competitive market, but a very profitable business. As I said earlier, development of a Group 6 mill Musirawas is on track for completion end 2022. Margin, of course, increases as more of our own crop is milled within our own mills. We expect, with the completion of Musirawas mill in December 2022, we expect to process 96% of all our own crop. The remaining 4% is because we have an estate in Aceh, in the province of Aceh, in North Sumatra, where we have a 2,900 hectare property, and it's not presently feasible to build a mill there. Of course, we are looking for more land around that area. Next slide, please. Again, on growth and continuing investment. Planting is continuing at Musirawas, and we expect to plant at least 10,000 hectares. As in the previous slide, the mill number 6 is prioritized to be completed in December 2022. The company also continues to invest in the group's estates, especially in infrastructure and other facilities. We also anticipate a reducing capex on existing estates from 2023 onwards. We are very serious about acquisition opportunities for sustainable new land around our existing estates. Of course, this goes through a process, and we are trying very hard to engage with owners around, especially around our existing estates, to see whether we can purchase a piece of property that can support our progress towards expansion. Next slide, please. To you, Liu.
Chandra, are you okay there?
Yes, yes.
Fantastic.
Liu?
Sorry, can you hear me okay?
Yes, we can. Thank you.
Okay, great. So revenue grew by 41.7 million against the same period in the prior year, which was a 33% increase. As we've seen, production levels of CPO were at a similar level to the prior year. However, the millgate prices were significantly higher. That average selling price, as Matthew's alluded to in the first half, was 1,035. Our revenue growth was slightly lower than that 43% increase in CPO price. And that's because, as a result of the export ban towards the back half of the first half, we were unable to complete as many shipments as we had anticipated. And you will note that our inventories at the end of the first half on the 30th of June were significantly higher than they have been in previous periods. We expect that to unwind, though, in the second half. And as we've touched on previously as well, we continue to see an increase in our sustainability premiums that we can charge, up from 1.9 million last year to 3.3 million in the first half. That has largely been driven by a 90% increase in the average palm kernel premium that we're able to charge. Those higher prices have in turn then allowed us to increase gross profit by 52%, or by $22 million, which is a 5 percentage point increase to 38% compared to the prior period in 21. Margin has increased despite some increases in costs. So our cost per tonne has increased by $90 from $335 to $425. And there's 3 to 4 main elements driving that. The biggest factor has been some inflationary pressure on our fertilizer costs. We spend a fair amount of money on fertilizer in the business, and as a result of the war in the Ukraine and with Russia and certain sanctions applied, there's been an increase in the demand for effectively non-Russian fertilizer, and as a result that has pushed the price up as well. So we've seen about a $30 to $40 increase per tonne in our fertilizer costs through the first half. That's roughly about double what we were paying in the first half of 2021. The other factor is that in the early part of 2022, we did see some adverse weather affect our East Kalimantan estates, and we did have to put some additional resources into maintaining and repairing infrastructure such as roads. So that has added to the increase in the cost. The other factor is that in 2021, we did have a non-recurring pension credit from Indonesia, and that has not been effectively repeated in the 2022 number. And finally, we also had the Bumi Mas mill operational through the first half, which was not in operation through the first half of 2021. And those fixed costs that come with the mill have added into that 425 number. So they are the main sort of driving factors for that increase. But despite this, as I said, we did see gross profit go up by the 52%. And as we continue our production and increase our production through the second half, we get to absorb that fixed cost base into a greater level of production, hence bringing down, hopefully, that cost per tonne through the second half. The increase in gross profit dropped through to operating profit and allowed us to see an increase in earnings per share of 65%. So that's up from 38.3p to 63.3p. And that allows us to continue with our very proud dividend policy and dividend progression. And we have announced an increase in our interim dividend from 10p to 12.5p, which is a 25% increase for the first half of 2022. So that fantastic trading performance generated significant cash flows, and we can see that our operating cash more than doubled compared to 2021's performance. So we went from 33 million operating cash in 2021 to 69.7 million in 2022. That's despite us continuing to invest in our infrastructure and our estates. So we're continuing to invest, as Chandra already alluded to, in estates, into roads, into buildings. And then we've also been putting our capital investment into the 6 mil at Musi Rawas through the first half. We also returned some of the cash that we generated to shareholders through the final dividend in 2021, and also we had a special 5p dividend announced at the end of 2021, which was also paid out in the first half of 22. That strong cash generation has enabled us to have a closing cash balance, gross cash balance at the end of 30th of June 22 of $70 million, with our gross borrowings at $56.5 million, resulting in a net cash position of $13.5 million. So we've moved from a net debt position at the end of 21 to a net cash surplus at the halfway point of 22. That has only enhanced the balance sheet for the group, with significant increase in our net current assets, really driven by that increase in gross cash and a reduction in the amount of borrowings due within the next 12 months. That strong balance sheet allows us to remain flexible and agile for any potential opportunities, inorganic opportunities, I should say, that may be in front of us in the coming months and years. So with that, I'll just pass back to Peter, who will run through returns for our investors.
Thank you, Luke. And I'll just touch briefly on the last two slides, although this is one that I'd like you to feast your eyes on for a moment or two, as it is something we're very proud of in terms of our track record. There can't be many companies, indeed commodity-based companies or AIM-listed ones, which have an unbroken track record of a progressive dividend for 30 years or indeed slightly more, i.e. either having maintained or increased the dividend year on year for over 30 years. As you see, the dividends paid in more recent years, particularly the last one, has been significantly higher, but we have every intention of continuing that progressive dividend track record. And finally, I won't go through each of these because it's really just a reiteration of the key points, the strategic pillars which I've mentioned, and the highlights from the results themselves, and indeed just ending with the exciting prospects still ahead for a number of reasons. But I see that you've kindly asked a number of questions, which between us, we've been making some note of as each other has been doing various parts of the presentation. So I think we can go straight into those. Actually, Matthew, if you can just scroll right back to the top, and I would suggest that we literally, I mean, there's some slight sort of doubling up, but the first two, actually, very funny enough, are very similar. The second one very slightly expands on the point being made, so I'll read that one in full, which is, do you regret becoming almost completely dependent on Indonesia in view of their export levy introduced recently? The simple answer is no. We think this has been an extremely good decision. Indonesia is the lowest cost producer and the most profitable. Production possibilities are there, and if you are an efficient producer in Indonesia, notwithstanding some of the levy changes that have been made, I think it's been a particularly turbulent time for these various levies that have come into play in the last 6 to 8 months. But actually, strangely enough, although we've seen a very turbulent period with the top rate of all the levies combined being $688 at one stage, and the current lowest level, which we're currently enjoying because of a holiday on one of the levies, being just $74, come the 1st of November, with the latest schedule of taxes having been announced, we will go back to almost exactly the same levy structure that was in place before all the turbulence, before the outbreak of the Ukraine war. And there's no question that Indonesia, as an Indonesian producer, one can fare significantly better than in Malaysia, where although there are some taxes, not as draconian as some of the taxes we've had imposed recently, but nonetheless there are taxes there. We would not anyway have been able to expand as in a majority held way in Malaysia in the way we have in Indonesia. And there are very significant labour issues in Malaysia, which I'm sure Chandra could, if we had time, talk for some length on. But in Indonesia, we have wonderfully rich organic soils, relatively low cost labour, many opportunities for a plantation company, a responsible and sustainable plantation company to flourish. And Papua New Guinea Indonesia produces 60% of the world's palm oil. Malaysia produces another at least 25%, so that's 85% of the market. Then there's Papua New Guinea, but costs in Papua New Guinea, although they don't have the same levy structures, are substantially higher. So we are very comfortable with really being an exclusively Indonesia producer. Let's move to the next point. Surely the use of export bans creates uncertainty in the marketplace and therefore an impression that Indonesia is not a reliable supplier. Buyers, therefore, are surely likely to seek alternative sources. Does the government not appreciate this? Would you like to take that, Matthew?
Yes, very happy to. I mean, I think the questioner makes a perfectly reasonable point. And I think the interesting thing here is that during the first half of 2022, whilst the price had been in somewhat uncharted territory, the Indonesian government had been looking for measures to put in place. And the use of an export ban, perhaps as I was trying to indicate, was something of a surprising move by the Indonesian government, and perhaps didn't have the effect that they thought it might, and was perhaps somewhat self-defeating in a lot of ways. I think it would be extremely unlikely, based on the representations they then received and the feedback they had, to see something of that nature occurring again. I think that a lot of the feedback that's then come back from some of the very large industry players to the Indonesian government is the fact that what industry really craves is certainty and stability. Of course, it's understood that there is going to be a level of taxation, but what's not helpful is those kind of changes and those kind of measures coming in and coming out in the way that has taken place. I mean, it remains the case, of course, that Indonesia is by far the largest producer of palm oil in the world, and will continue to be so. But I think the government, as I say, has been on to come up with a kind phrase for a learning journey through the first half of this year.
Fine. Then let's look to the next one. Sorry, which one? We're the top.
So I think that it's the top one there, Peter.
Yes. Can you provide any guidance on long-term growth rate and demand, you mentioned, combined with any view on outlook for supply-demand balance and pricing outlook? I mean, I'll just make a very, very broad, brief point, which is that in some ways it is rather difficult to measure this, because palm oil, of all the competing vegetable oils, palm oil is the only one which it is a permanent crop. Once it's in the ground, it's there for 25 years, whereas all its competing crops are annual crops, and it is a decision of an individual farmer as to whether to plant that crop, soya or rapeseed or sunflower, whatever it might be, depending on how that farmer views the outlook for the year ahead and the likely price they will receive compared to planting an alternative crop. But broadly speaking, demand is growing for vegetable oils as the world becomes, the world population grows. And the reassuring thing is that palm oil is the cheapest of all the vegetable oils that is produced, and Indonesia is the cheapest area where palm oil is produced on any significant scale. And therefore, when other producers are finding it difficult to compete, an efficient Indonesian palm oil producer will keep their head above water for longer than the rest. I mean, I'm touching wood firmly. We, as a group, in the time 35 years or so that I've been with the group, we've never lost money on palm oil. Is there anything briefly you want to add to that, Matthew, in terms of the long-term supply demand?
I think on the demand side, exactly as you described, there are all of those long-term trends for increasing demand continue. On the supply side, clearly there are some indications that certainly in Malaysia, the amount of investment going into the industry to support the supply side is decreasing. So you look at that sort of balancing act that has to be managed. The question then led on to what that might mean for pricing. Of course, you've got continuing uptick in demand and then some supply constraints. You can form your own judgments as to what that might mean for the pricing environment.
Indeed. Let's move on to the next one. You mentioned potential for growth investments, acquisitions. Can you talk about the possible scale of these and what hurdle or payback periods you use for assessing these? I'll kick off with perhaps answering the first part of it. Yes, absolutely. I mean, we've stated it is a strategic priority to identify and secure new acquisitions, particularly around our existing projects where we have surplus milling capacity. So especially at our biggest project, Kotabangun in East Kalimantan, where we have 15,500 hectares, we'd like to increase that to 20,000 hectares so that we can make full use of the two mills where we do have some current surplus capacity. And going back to that orange line versus the green line you saw earlier, it'd be good to turn more of that orange into green and therefore achieve a higher profit margin from processing our own crops rather than buying in independent smallholders. So that is a priority. If you like, one silver lining of the fact that the palm oil price has come down from the meteorically sort of high levels of the recent past, although we're still at very healthy levels, is that the expectation on the part of prospective sellers of land or of projects has come down to more realistic levels again, and we are seeing one or two sellers creep out of the woodwork again, and we hope to be able to announce some success in acquiring some new projects, ideally around our existing estates, and potentially also some standalone projects as well. I don't know if either Matthew or Luke, a bit unfair on Luke to sort of put this directly immediately on terms of hurdle rates and payback periods. But yeah,
I mean, just very briefly, yeah. I mean, we tend to think in terms of hurdle rates rather than payback periods. It's just the way in which we tend to operate when we do feasibility analyses. We will tend to start with it as a minimum, something of the order of 12%, but you think things are moving a little bit clearly as the interest rate environment is moving a little bit, and that will affect how we judge these things. It's not a completely fixed analysis, so I can't say there's always a precise and exactly fixed hurdle rate. It'll depend on looking at how inevitably there's a little bit of movement in our WACC analysis.
Fine. The next question is, would not the considerable financial bounty created by high prices allow for a much bigger share buyback than the company is currently implementing, given the share price discount to NAV? This must surely be one of the most attractive uses of Evans's financial resources. I mean, we agree that this is an excellent opportunity to buy back our own shares. And as you know, we did reintroduce that recently at our AGM, which was voted through by shareholders, and we have started on that journey. We announced in the market the initial authority, and we will, I'm sure, continue. There'll be further announcements on that soon. We are, however, restricted by how much we can buy. We can only acquire 25% of the average daily volume traded over the last 28 days. So there is a significant restriction on the amount that we are permitted to buy under the MAR, market abuse regulations. But absolutely, we will, I'm sure, continue with that policy, as it does represent. You're absolutely right. It's equivalent to buying our own projects at an average of what, 13,000 per hectare, or compared with where they've been independently valued at some 20,000 per hectare. Next question: what is the lifespan of a singular palm oil tree, or of an oil palm, as we tend to call it? Chandra, just briefly, can you describe the lifetime of an oil palm?
The productive life is about 25 years. Productive life, of course, the palm oil, if you are not commercially growing, it can grow up to 50, 60 years. But usually plantation companies, maximum they'll keep it is up to 25 years.
Yeah, so a 25-year lifetime, which peaks
productive.
10 years or so in some maximum production period. Let's just move to, because we had some previously, we'll come back to that in a moment, but there were one or two questions which was pre-submitted. Luke, perhaps this one for you. Do you have any extension planting target, i.e. continuing planting of our existing land, I believe that refers to, and when the 22 annual report is published? If so, are you able to reveal that information today?
Great. So I think, thanks, Peter. Thanks for the question. Most of our planting at the moment is targeted really at Musi Rawas, as we alluded to in the presentation. And we're continuing to plant there throughout 2022. And you can see that we are well on our way to the 10,000 hectare level that had previously been communicated for that Musi Rawas estate. So that planting continues. There's no specific other planting targeted in 2022. The only thing I would mention is that should we make a acquisition of some sort, should that require some form of replanting or additional planting, then that would be something that may change the profile of that investment. But that's obviously something that would be incremental to what we're currently planning to do. And delighted to say that planting for 22 is definitely on track.
Thank you, Luke. Another question: are you able to share any insights as to the purpose of the new tariff on top of the export levy and export tax, given domestic cooking oil prices should be more affordable now? What has prompted this? Do you want to have a crack at that?
By all means, yes. So just after the export ban was lifted in Indonesia at the end of May, the Indonesian government, as I think I may have mentioned already, introduced a sort of third element of taxation on palm oil. So as well as the export duty and the export levy, they introduced an export tariff at a fixed rate of $200 per tonne. That was actually only a temporary measure, which ran until the end of July, and so that no longer applies now. That is no longer in play. We're back to just having the duty and the levy as has been the case for a very long time. In terms of the purpose of that temporary and short-term tariff, I think having lifted the ban on exporting, there was some sense that the Indonesian government was still sort of encouraging sales for domestic consumption. So effectively saying, well, yeah, if you sell for domestic consumption, there's no tariff, but if you sell for export, then there's this additional cost to export, the $200 tariff of exporting. So that was the scenario that was in play for a short period of time up to the end of July, but as I say, no longer applies now.
Chandra, perhaps one for you. Reduced crop production in Bangka appears to be due to a catch-up in 2021 first half. Yeah. Do you expect the current levels to now be normalized in Bangka?
Yes, current levels, presently we are already 14% above budget. We have already harvested 187,000 tons compared to the budget of 164,000 tons. So we have caught up. And Bangka is really going through a very good harvest right now.
Thank you, Chandra. What do you expect the average mill gate price to be in the second half of the current tax? In the second half, if the current tax regime is unchanged? I mean, it is hard to crystal ball gaze. Obviously, you never quite know what's going to happen. Having said that, the market does generally seem to have settled down a bit. As we announced in our recent announcement, prices, ex-millgate prices, are currently trading at around the 750 level, $750 per tonne. So that's the net price to us. And for different reasons, it may not be unreasonable to expect prices to continue on a net millgate price to continue around that level, but who knows? We can't know for sure. Anything to add to that?
No, I think that's exactly right. Okay. I don't think there's more that we can say right now.
Yeah. What are the perceived threats to continued profitability? Politics, weather, you want to have a crack,
But
Matthew?
by all means, I mean, the questioner has offered up those two as suggestions for continued threats or future threats to profitability. I mean, actually, I would say that, you know, politics is, whilst we need to continue to keep an eye on the situation and the fact that there's been a little bit of activity from the government in the first half of the year, we would still say the overall political environment in Indonesia is still very much one that's, you know, business friendly and actually very, very much encouraging in terms of, you know, investment in Indonesia. So, you know, I take the point around why one might raise that as a sort of query, but we would still say the environment politically is still very supportive. Weather-wise, I mean, of course, we're susceptible to the short-term impact of weather situations in various locations. But again, we come back to a point that we would have made many times before, which is the remarkable hardiness of oil palm as a crop, and the fact that it can withstand so many things. So whilst I think it's absolutely fair to raise both of those challenges, that we continue to monitor both of those situations very carefully, but I wouldn't say that they are substantial threats to continuing profitability of the group. Obviously, what we do continue to monitor is the overarching pricing environment within which we find ourselves. It's not something we can control, but we continue to monitor it extremely carefully. What we do have more control over is, of course, the costs of producing every tonne of palm oil. And that's something that we keep under very tight watch and tight control. Of course, you know, we talked a little bit about inflationary pressures in the first half, and that's something we continue to keep a very close watch on to make sure that we deliver every tonne of CPO at as low a cost as we possibly can.
Okay, there's a related question. Is Indonesia politically stable? In a word, yes, we believe it is actually, and it's enjoyed a remarkable period of political stability and has actually been increasingly benign towards foreign investors such as ourselves in recent years. Let's move on to at least a couple more questions if we can. There's one on CapEx there. Yes, you mentioned CapEx should be lower in 2023 versus 2022. Can you quantify this, please, Luke?
Yes, I think, you know, there's been a consistent message now for the past 18 months to 2 years about the kind of profile of capital expenditure. The Musi Rawas mill is due to be completed towards the end of this year, and there's no intention to add any further mills at this stage to our existing estate. So that would be a significant drop-off. There will continue to be a level of kind of operational capex that's required to maintain the infrastructure on our sites, and clearly as planting profiles come around, there may be some further investment required there. But in terms of quantifying, we're kind of going through a period at the moment of planning 23, but it would probably be somewhere in the range of perhaps sort of 60 to 70% of current levels by 2022 levels that we would look at for 2023, and probably a further reduction onwards from 2023 and 2024. But I'd be a little bit remiss for, you know, trying to predict that at this stage, but probably a sort of 30 to 40% reduction in current capital expenditure levels could probably be expected for 23.
Thank you, Luke. And perhaps we'll make this one the last question, if that's all right. There may have been a couple that we've missed, but I think broadly the essence of, you know, what's been asked has been covered, as though they partly overlap. But this is actually a two-part question, which I might hand over to Matthew to close things out in terms of the questions. Is the use of palm oil as a biofuel destined to increase? And then second part, what are the adverse health effects of its use in food?
Yes, so I mean, taking each part of that question, firstly, when it comes to biofuel, yes, I suspect it is highly likely that we will see more use of palm oil as a biofuel, particularly locally within Indonesia. The Indonesian government has an increasing mandate for for the use of palm oil as a biofuel, and I expect that will continue to increase. As for health effects of palm oil, it's another vegetable oil. I certainly wouldn't flag up any concerns over significant health issues with the use of palm oil versus any other vegetable oil. Like so many things in life, it's all things in moderation. You shouldn't have too much of it in your diet, but then again, there's lots of things that you shouldn't have too much of in your diet. If you want to look at things in a bit more detail, there is more information that I can point you towards on our website on this topic.
Thank you very much indeed. As always, you've been very generous with your time and covered off pretty much every single question that we've had, and I think that's great. So thank you indeed for that. And Peter, perhaps before redirecting investors to provide you with their feedback, which I know is particularly important to you, I could just ask you for a few closing comments, please.
Well, I'd really just like to thank everybody for tuning in, and thank you for those who asked questions, some really good, interesting ones, and I hope we've managed to answer them sort of adequately. You know, feel free to be in touch, whether you're an existing investor or a would-be investor. We're always happy to hear from shareholders or would-be shareholders. But thank you very much for your time.
That's great. Thank you all for updating investors today. Can I please ask investors not to close the session? It should be automatically redirected to provide your feedback, and all of the team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of MP Evans Group PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you and good afternoon to you all.